if you are basically, if you finalized your tax return for 2023 or any other year for that matter, and you're basically owing money with the return or you're getting a large refund, whatever the case is, if that number is over, let's say anywhere from $1,000 to $3,000, you might be asking yourself, what do I do next? How do I plan for this coming year? And the answer is you probably went to a tax preparer and not a tax professional. So the difference is quite vast. Basically, a tax preparation service just does tax preparation. They don't really do tax planning as much, if at all, because they're just basically typically hired for the season. Maybe the way the business tends to be structured, it's not really optimized to give further guidance than some basic hand-holding to help the client understand how to mitigate for tax in the following year. So it's very important to be able to help the client with understanding where they went wrong, how to adjust their withholdings or make estimated tax payments to avoid having to owe again. So especially if we're dealing with anything over greater than $3,000 with your return. So it's, again, if you owe, our rule of thumb is really $3,000, and I'll explain why in a minute. So when you're dealing with taxes and tax laws and regulations and your different sources of income, it's going to be very complicated for you to actually plan for your estimated tax payments, because a tax return is a lot of moving parts, and there's a lot of variables that are riding off of one another and different calculations that are coming into play on your tax return. It's like many different moving parts. So people tend to have a lot of changes throughout their year. And those can be vast. Like there's so many changes that can happen. I mean, switching jobs, moving states, getting bonuses, like stock options, selling something. So many different things can happen with an individual or a couple throughout the year that planning for it becomes really complicated. And all these different rules and regulations and calculations are going to come into play. So if you think that completing your W-4 form and the state equivalent with your employer is going to suffice, you're gravely mistaken, because there's no way that you're going to be able to calculate all of these various complicated life situations that can arise by using a couple of page forms, right? It's just, think about it. It's not very practical. So what do we do in practice? How can we help the client quickly plan for this without getting into too much of the nuts and bolts and actually doing like a formal tax projection or a formal tax plan? Well, the answer is quite simple. What we do is we actually help the client understand why they owe taxes this year versus the last year. We help them understand that owing up to $3,000 or owing or getting a refund of over $3,000 is really still considered decent outcome. It's when you're owing over or you're getting a refund of over $3,000 is when something really went wrong, and you should have sought out the help of a tax professional during the year. So let's say you sold a rental property or something like that, or you're expecting a large bonus, or you're switching jobs, or you're moving states. That's the time to really seek help and obtain the help of a professional that deals with taxation all year long and isn't just like a tax preparation service. Somebody that understands the upcoming changes with the rules and regulations and can possibly help mitigate any additional tax consequences that might arise by not doing or structuring things properly for that life change, that event that's going to happen. So again, $3,000, if you owe like up to $3,000, it's really still, unless you have like a single W-2, nothing else going on, it's very difficult to pinpoint you to that plus minus $3,000, because there's too many moving parts, and you would actually have to do a formal tax projection. And a formal tax projection or tax plan is really when we're sitting down and we have variables and different inputs for a projector. And we're putting in data into a future tax projection software based off of what the client's inputs are. And it's very hard to pinpoint this going into the future because things will change. And so the information that we might obtain from the client in the middle of the year compared to like the third quarter or the last quarter, things will change so greatly that those inputs have already changed. So we're trying to prepare a tax return ahead of time. So if you're right now sitting down and you owed, let's say, $10,000 with your return, and you think that you can plan for 2024, it's very complicated because you have to project everything forward, be able to basically like really have those precise numbers. Now, when we're dealing with like big life situations, obviously we can help tailor that much more. But if we're trying to pinpoint every little single thing that the client's going to have by the end of the year, that's an impossibility. It's going to be, unless we're dealing with like a single W-2, no major changes, it's going to be difficult to do. But when somebody comes to us and is like, hey, I'm selling this rental property, I'm expecting a large gain, here's those variables, that's much easier to navigate and give like a ballpark figure because we'll have a lot of the data. And we're not trying to be like super precise. So just keep this in mind that it's by no means an exact science, unfortunately, unless we have very good data and we're very, very precise with it. And with some people, that's very possible because, like I said, they have a very basic situation where you have just one W-2. It might be a small increase in pay. And it's simple to project out into the rest of the year and to be able to pinpoint exactly how much that individual is going to owe. Then we can really get very close. We can get to plus minus $1,000 for that individual. But for everybody else with kids and multiple sources of income, maybe job changes, moving states, all these other variables make it very complicated to pinpoint. And so we can help. We can definitely get it to plus minus 3,000, but that's as close as it tends to get. With the more variables that change, the harder it becomes to get somebody to that break-even point. Because some people, for some reason, feel that they can complete a W-4 and get as close to break-even with the government as possible. And in reality, it's really not that straightforward. All right, so I guess that just left you with some more questions. So how do we plan? What do we do, Greg? Help us out. Give us some suggestions. So I'll do what I do for most of my clients, and we have some other videos. I'll link them below that goes into what our estimated tax is, how to plan for estimated taxes. But I wanted to leave you with some great advice and basically what I furnish my clients with whenever they come to us, whether they're new or existing clients. I always want them to understand why their situation changed, what is it that triggered additional tax this year, and best how to plan for it, right? So in the current tax system, if you're going to owe over $1,000 with your filing, then you need to start making prepayments so to avoid getting penalized. So when you underpay your taxes, yes, there's penalties and interest that will accrue. And the reason is because taxes are due quarterly. They're not due with your tax return on April 15th. Everybody thinks for some reason that, you get to April 15th and it's time to square up with the IRS and the state. No, that's not how that works. You actually have to make installments throughout the year if you're going to owe any tax. And if you don't make those installments quarterly, then you're going to get penalized for what we call underpayment of taxes because they were due throughout the year. So that's what a lot of people don't realize, and they think that everything's due in April. It's due in April if you're pretty much paid in and you owe a little bit more, then that's when it's due. But otherwise, you have to meet a rule, and that rule is basically the safe harbor rule of prepaying your taxes. So you have to prepay either 100 or 110% of last year's tax, and I'll explain what's 110% in a minute, or the smaller of 90% of this year's tax, right? So whichever number is smaller is the one you want to prepay to avoid getting penalized for not making your installments throughout the year. So if you owe, let's say nobody's withholding for you, like you're self-employed, right? Then nobody's withholding for you. So you have to make those quarterly estimates. But the question becomes, how much should I make my quarterly estimates, right? And again, the rule is 100 or 110% of last year's tax, or 90% of this year's tax, whichever number is smaller. If your AGI, if your adjusted gross income is over 150,000 in the prior year, then you need to prepay 110% of the prior year's total tax this year to meet the safe harbor, which is basically another term for avoiding penalties and interest for not paying in your taxes, right? It's the safe harbor method of paying in your taxes, or 90% of the current year's tax, whichever number is smaller. Well, the problem with that is we don't know what 90% of this year's total tax is going to be because of life changes, because of the complexities that go into trying to calculate your total tax ahead of time, like I described. So in the perfect world, if we know exactly what 2024 or whatever future year is, if we know exactly what that number is, then of course we can plan for 90% if that number is smaller. So what we typically do is we call it, when we talk about prepayment of prior year's taxes, we really call it the blind method of prepaying your taxes. So the blind prepayment method is a term that we came up with because we're just blindly prepaying the prior year's tax and assuming that this year it's going to be about the same or maybe more. But we want to avoid underpayment penalties, so let's at least prepay last year's tax and let's assume that your income is going to go up this year. With the caveat that if something does happen, if some life change does occur, you lose a job, you're selling something that's going to trigger a big taxable gain or something like this, or you're moving states, whatever the case is, if you have some major life event, then you come seek us out. Otherwise, we put you on this blind prepayment, this almost like just prepay your taxes blindly, the same as last year. And if something does arise, you make sure you reach out to us, and we as tax professionals will help do something more customized to get you ready for that life change, that life event, to make sure that you're not underpaid or overpaid greatly by just simply prepaying the last year's tax, right? Like all of a sudden a spouse loses a job and can't find one for 3 months, not going to have one for the rest of the year. Your income is going to greatly reduce. We don't want you to keep prepaying last year's tax because you're having a major life event that would put even more stress onto your finances and everything. So you have to hire a professional to plan for this change and not to fall short as well. Like you don't want to overpay, but you don't want to underpay. You still need to pay something. So that's basically what we're dealing with on a regular basis. And hopefully your tax preparer is also a tax professional and can help you understand the complexities of the tax laws and why it's complicated to plan for 2024, why it's complicated to use your W-4 form to prepare for your current year tax installments. But now what I want to do is I'm going to jump on the computer, guys, and I'm going to give you another bonus. If you stick around, I'm going to show you some industry secrets, how to plan, how to make your installments quickly, easily, without having to really try to figure out this W4 form and the state equivalent, and how to really just quickly and easily assess how you should be making your installments if you're an employee of a company and you're on W-2. I'm going to show you this trick. This is what I show my clients that are working on the W-2 and are employed. And I think they really appreciate it because it's a very easy way to think about how to make installments. It takes the complexity out of it, and it makes everything that much more straightforward, and you'll understand. But again, just always keep in mind that we're always trying to prepay the prior year's taxes unless we know that there's some major change that's going to come, and then we have to be more customized. We can't just do a blind prepayment. All right, guys, so thanks for joining me back. Now, as I promised, I said that I would help you plan for your tax installments, and here I am. So the easiest way to plan for your tax installments is to understand where, first of all, your total tax is. So I'm going to go into Google real quick and basically pull up a 1040 form for 2023. And so when you're actually done filing your tax return, this is where I want you to go. So this is your individual income tax return for 2023. So some key lines that you should understand is line 11 where it tells you this is your adjusted gross income. So this is gross income, and gross income is defined as income from all sources, less any adjustments, okay, less deductions that are specifically stated in the tax code that would reduce your gross income to arrive to your adjusted gross income. So if this number is over $150,000, you have to plan for over 110% of last year's total tax. So your total tax is reported on line 24 of the Form 1040, where it tells you in bold, this is your total tax. So why don't we take an example and we'll look at some numbers. So if this is your, let me just get some commas going in here. All right. Now, if your total tax is going to be over 150,000, I'm sorry, if your AGI, so your adjusted gross income, is greater than 150K, you need to prepay 110% of the prior year total tax. So the question then is like, so let's say my total tax is $21,000 for the prior year, then you're going to simply take that amount, multiply it by 110% to arrive to $23,100. So this is the prepayment that you need to make over the course of the year to meet the safe harbor method of prepaying your estimated income for the current year to avoid an underpayment penalty. Okay, so this is key. All right, then I want you guys to understand how to divvy things up. So when you're going to go and look at your prior year pay slip, you will notice that there should be a line that says federal taxable income. Because remember, when you're getting paid by your employer offers fringe benefits like health insurance, HSA contributions. Your employer is offering 401k. So those things are not taxable for income tax, but they're taxable for possibly Social Security, Medicare. So if it's the case where you have fringe benefits, then you would have a different gross pay from your federal taxable pay. So if you earned $1,000 and you put $200 of that into your 401k, your federal taxable income is going to be $800. That's the line that's important for tax preparation, not how much you're getting paid before your pre-tax deduction. So this is really key, guys. I can't emphasize it enough. So go back to your last pay slip on your 2023 year and look for that. Look for what it says. And by the way, states have an equivalent. So some things are excluded as well for the state side. It depends which states. Some states are funky, like New Jersey versus New York. New Jersey doesn't exclude 401k from taxable income, but like New York does, right? So that's why it's important to be on the know for that as well. Now, look for your federal taxable income. We're just going to deal with the federal side here, guys. We're not going to deal with the state. It runs similarly, but believe me, there's even more differences when it comes to the state side, but the concept is pretty much the same. All right, so what we're going to do now is we're going to look at taxpayer and spouse, okay? So the taxpayer, let's say in this particular case, earned $109,934, and let's look at the 2023 tax year. Let's not look at 2024. This might not be, oops. Let me just get rid of that, not to create any confusion. All right, so you're going to be looking at your pay slip. You're going to pull up the federal taxable income, and for the taxpayer, it came out to $109,934, and for the spouse, it was $57,542, for a total of $167,476. And we could do something like $58,000 just to make it even, $110,000. All right, so that's a combined taxable income of $168,000. So what I want you to understand is that this taxpayer's taxable gross income is 65% of the total, right? Because we're dealing with a married couple. I'm not dealing with like a single individual. The idea is because obviously if you're single, I don't really care. You owe all of it, right? Here I'm helping you how to plan for the installment and how to understand how to split up the differences between two people. All right, so if this particular person had, let me get rid of this so it's not confusing. So this particular individual had 65% of the total, and this one's 35. So what we want to do now is to make sure that if we're dealing with 23,100 as the required installment, right? Because remember, we said 23,100 is the prepayment, and so we want to do the same thing here, right? How much should this spouse then be paying in towards this installment? So you just simply multiply 65% by the 23,100. So the target for the taxpayer is 15,125 through withholding, okay? And for the spouse, it would obviously be the difference, right? So this is the target for one and the target for the other. All right, guys, so now I've helped you understand how to plan as to how much each spouse should contribute with their withholding, or a combination of withholding and sending in additional estimates, because you can do both. This conversation is going to discuss how to plan it through your withholding only. And like I promised you guys, I'm going to make it very easy for you to understand. All right, so now that we understand the total tax, we understand our AGI, we understand that if we're over 150,000 in the prior year, our requirement is now 110% of last year's total tax. So now we understand how much we need to make in installments this year. And now we understand how to split it amongst the two of us to make sure that one spouse doesn't end up paying much more than the other. And we're trying to make it equitable. Again, some people have one pocket and they don't care. They're like, I'll fork up the difference, whatever. That's already amongst you two how to decide that. But just understand that between both of you, your target is still 23,100. How you split it up amongst yourselves is a whole other question. That is not, that's way out of the scope of this engagement. Now, so once you're doing that, what you're going to do next is you're going to go and look at your current pay stub, the very last pay slip that you've received, and you're going to look at, again, you're going to look for your federal withholding to date. Okay, so we're right now, as you can see, this is March 26th. So if this is our payslip data, what are we looking for, right? So the payslip data always has the start date, it has the end date, and it has the paycheck date. So these are very important, okay? The start date and the end date, so if we're dealing with a salaried individual, okay, that individual is getting paid typically on the 15th of each month and at the end of each month, right? But the pay date is different from the pay range, right? So from the pay range, you're getting paid from the 1st through the 15th, but the actual check date is dated, let's say, for example, 3 days after. Now, this is not always the case. It could be the same day. It all depends on your situation. Some people get paid every 2 weeks. Some people get paid every Friday. So you're going to go into Excel and you're going to create a table just like this where you're laying out the pay date. In this specific example, I just set it up that it's always going to be from the 1st to the 15th and you get paid 3 days later. Then the next one is going to be the 16th through the end of the month, you get paid 3 days later. And then the cycle repeats, right? The 1st of February through the 15th of February, got paid on the 18th. Then it was a leap year, right? So 2/16 through 2/29, got paid 3/4, and so on. So once you get to 3/18, where right now we're on 3/26/2024, you're gonna look at how many, so if this is federal income tax withheld on your pay slip, and let's say, for example, you're having withheld $268 every single paycheck, for federal income tax, that means that by the time we're over here, right? Where are we now? Right now, currently, we've already accumulated $1,340 towards our federal income tax. And let's assume that this is for the spouse. So the spouse is going to be way off target because that spouse needs to make $79.75, right? And if we were to go all the way through the end of the year, it would be $7,600, right? So let's take a look at what this would look like. Let me just remove this. And let's go all the way through the end of the year. So this spouse would reach $48.24 by the time the end of the year comes. So that would fall short of this target here, right? So that's where we want to catch it, and we want to adjust the W-4, and I'm going to get to that in a minute. So let's go back to the pay dates. Why is this important? Now, it's important to understand that for W-2 purposes, okay, even though the date range is within 2024, if the check date is 2025, that's already part of the 2025 W-2. This is the key. That's how payroll works. Payroll works by check date because it's on a cash basis of accounting. It doesn't work by an accrual. It doesn't work by the date range. So when you're looking at your pay slip, those are the 3 dates that are on all the pay slips. It doesn't matter how your calendar works, whether you're getting paid every 2 weeks, whether you're getting paid every Friday. I don't care if you're getting paid, monthly, whatever the case is. There's always going to be three important dates to look at. And for tax planning purposes, you're looking at the paycheck date because that's going to determine whether that's going into the next year or not. So when you reach all the way over here in column T, and you're in column T, and you're looking at and you're doing this table out in Excel or something to help you plan, and you're going to notice that it says 12/31/2024 is the last date range. Yes, it is, but the check is going to be dated 3 days later. That's already not your 2024 W-2. That already spills into the next year. So if you're counting on the 268 or whatever that number is into that year, you're going to miscalculate because you're basically going to have that money roll into the next year's withholding and reporting on the W-2. So this is key. All right, so that's why I wanted to bring that up for your planning. So now you're looking at let's move on to now the actual nuts and bolts a little bit. Stay with me, guys. This is not overly complicated. Like I promised you, I'm going to make this super easy. And if this is not simple enough for you, I don't know what is. So now you're looking at your pay slip. You saw this video. You're super excited that Greg showed you how to plan for taxes, made it super easy for you. You run to the Excel, you put all these figures in, you're sitting there just like I am right now, and you're looking at your table and you're in column G, and you're like, okay, so by the time I get to this last paycheck, I'm gonna be at 1608, right? So right now, like you don't have time to change your W-4, so you know that by the time you get to your April 3rd installment, you're gonna be at 1608, but yikes, you're going to be short because you're 20, by the time you get to the end of this, you're going to be at 48.24. And Greg said, I need to be at 79.75, right? So 79.75 minus 48.25, I'm going to be 31.51 short. Oh my God, what do? I don't understand this W-4 form and the state equivalent. How am I going to plan for this? And by the way, this exercise should be done also for your state side. It's not that complicated. It's basically the same thing, right? So again, now you know how much you're going to be short because now you understand how to do basic math, right? Like, and I'm not being facetious. I know that you guys know how to do this. So once you're at this number and you've identified your shortcoming, that's when you're going to count how many more payrolls you have left between this very last one and the end of the year. So let's go ahead. Let's do a little formula. It's called count up. Old school, and then count up how many more withholdings we have, right? So we have 12 more, and you can use either row, right? It's going to give you the same result. You got 12 more paychecks. So what do? So we're going to take 3151 and divide it by 12. Boom. That's that simple, guys. So you just identified how much you need to withhold. So I want you to go back from here, and this is where it's brilliantly simple. You're going to go fill out that W-4 form exactly the way you've had it filled out before, but where it says additional withheld, you're going to plop in what? What are you going to plop in, guys? If you guess 263, you're on the money, you're spot on, and you're becoming a tax professional like we are. All right, so where's your Form W-4 for 2024? You can Google it. But you know, you can, and by the way, you can modify your W-4 form as many times as you need with your employer. There's no harm in it. So you're gonna fill out all of these weird funky boxes just like you've done before. So you're gonna keep everything the same except for what, guys? This line right here, correct. So extra withholding, you want withheld each payroll period. Here you're gonna put in that $263. Boom, you're done. You're done, and you just planned for your 2024 estimated taxes. And I told you it was going to be easy, and I promised you guys that you're going to learn how to make this super simple. That's what you're going to do. You're not going to worry about figuring out this form. This form, guys, is not going to help you if you think that a form that's one page and a state equivalent is going to help you plan for a lot of life changes and all sorts of different nuances. It's probably not going to do it. You know, you switch jobs, so you might not have like a drastic life change like what I discussed earlier, but you'll have some sort of change. And we'll expect that you're going to just make more money, right? Or a little bit less, but still, we don't want to account for major changes, okay? We want, if there is a major change, that's when you seek out a professional. Then you're going to end up overpaying your taxes or underpaying your taxes. But we're assuming that you're probably just keeping a job, maybe switching a job, and things are gonna change in either you're gonna make a little bit more money or you might make a little bit less money, but we are not dealing with a major change and we're just prepaying our taxes. Remember, if you're hitting, your goal is to be between $1,000 and $3,000 underpaid or overpaid with your taxes is still great tax planning. You're still not considered, and I know for some people that might be a lot of money, but in the world of complicated tax forms and complicated calculations, it's still considered good tax planning. Trust me, I've been doing this for many years. I've handled probably thousands of tax returns by now, and I'm telling you that that's still very good tax planning. So unless you're dealing with a single W-2 and a very straightforward tax return where things are incredibly predictable, that's considered good tax planning. All right, guys. So that's that from Freyman CPA. Don't forget, brought to you by Atlanta Business Accountants, here helping you guys understand the complexities of tax law. And we always make it simple for our clients because what? Our success is always going to be your success all day, every day. And if you walked away from this knowing more, and if you feel that you've gotten value from this video, please like and subscribe, share with your friends, or just leave us a comment below. Let us know that you like what we're doing and give us some feedback. Let us know if you want to see anything interesting, any kind of situation you've ran into that we can create a video and help you along. All right, guys, this is Greg Freyman signing off. Hopefully we've made your estimated income tax way less hassle-free for this coming year and going forward. Thanks again. Thanks for watching. Bye.